Good afternoon, and thank you for joining us for what we hope will be a fun and informative discussion. This is Current Trends in Leveraged Finance, episode number 3 of the Financial Poise Leveraged Finance series. You can read more about financial poise on slide 33. Our panelists today are Andrew Hutchinson of Much Cellist and Ethan Conshu of Sidley Austin. My name is Krista Mancini from Jones Day, and I will be the moderator for today's discussion. You can see our names on slide 6, and our bios are on slides 26 to 28. Neither Financial Poise nor we intend for this to be an infomercial, though, so you don't have to listen to me read those bios. If you want more information about us, you can refer to our bio slides. Just a note about the slides in the PowerPoint presentation. We may call your attention to slides relevant to what we're talking about, but it's unlikely. This is meant to be more of a discussion, so don't worry if you're listening and not viewing this presentation. You'll be fine. The slides are not critical. We want to thank our co-producer, the National Law Review. You can read more about the National Law Review on slide 3. The Financial Poise webinars are supported in part by sponsors. The sponsor for this webinar is Max Asset. More information about Max Asset can be found on slide number 4. Last thing before we begin, you'll see a disclaimer on slide 5. You are not our clients. We are not your lawyers. And what we do here today is for general education purposes and not for you to act on without appropriate advice. So with all that out of the way, let's dive into the discussion. So Ethan, we're seeing a slight rebound of M&A activity in the market since the slump in 2023. What are you seeing this year in terms of acquisition, financing activity, and what types of deals are getting done?
Yeah, thanks, Krista, and thanks for having me. So yeah, we've seen there's been a little bit of a rebound, but it's still slower and a little bit less M&A than there was since the recent, peaks in 2020, 2021. There's still a pretty wide bid-ask spread as to valuations and pricing, where buyers and sellers are having a hard time bridging that gap and getting to a deal. Part of that is that we're still in an elevated rate environment, so buyers are less eager to lock in pricing for 5 to 7 year tenors, where there may be an opportunity to just hold off for a little bit and rates may come down, where they could get a better return there if they can just hold off. Another broad theme that we'll probably mention a few times is tariffs. A little bit of the elephant in the room, and uncertainty as to how those are going to affect target assets, underwriting processes, and increasing transaction timelines that all kind of contributed to put a damper on the broader M&A market. However, in that environment, we are seeing some deals get done where in certain situations, sponsors are running up against, hold timelines that are getting long in the tooth where they need to return some capital to LPs. So we'll see, we've seen a continuing trend from 2024 and continuation vehicles and bringing in other sponsors in recaps where it ends up in a 50-50 structure. CVs, up being a transaction where sponsor will purchase an existing investment or portco from one of its funds by another fund. They may do that just to cycle out LPs. They may reduce their exposure altogether to that asset by bringing in outside investment. We've also actually seen some where they just aren't ready to sell the asset yet and want to buy some more time. They think there may be some more runway on the investment or that it may do better in a lower rate environment. They're just not ready to exit that investment. So they'll bring in additional investors and increase the powder. But certainly more of the flavor of cycling out LPs and returning capital than expansion to this point. And again, a lot of that's just driven by longer hold periods due to a few years now of exit opportunities not looking quite as attractive. And in a similar vein, we've seen a number of refinancings and repricings, since there are a few factors that have led to dampening the M&A market. One of those being rates, but those have started to go down. So we've seen some opportunistic refinancings in that space. And there's a little bit of a backdrop of kind of a tug of war between the syndicated loan market and the private credit market, where following COVID, where there was some uncertainty in the syndicated market, and even in more recent years where there's been some more market risks that have kind of hurt syndicated lenders. Like the example is Twitter, where they got stuck with the loans and couldn't market the loans. Private credit kind of came in and took some of those deals you would otherwise expect to be in the syndicated market. So the syndicated market is being a little more competitive in pricing, trying to take some of that back. And then in turn, private credit is actually making some pricing concessions and trying to hold on to those deals. So those are both kind of contributing to prices going down or spreads coming in, which provides a lot more refinancing and repricing opportunities in a market that's otherwise not great for exit opportunities. And even where companies aren't really ready to pull the trigger on a refi or needing to do a CV or a 50/50, they're still pretty active at the portco level since these smaller deals are easier to get. They're less risky since they can often be fully debt financed without putting in new equity. And there's just more certainty of negotiation and execution. And it's easier to get DDTLs and incrementals from your existing lender group without having to go back to the market. So we'll see, even where they do incrementals, they'll try to reload their DDTL or add that feature in if they're comfortable that they'll use it in the next 12 to 24 months, just to reduce kind of market risk of what things may look like in the future. So that's kind of the lay of the land at this point, what we've seen getting done to this point in the year.
Interesting. Awesome. Thank you, Ethan. Andy, given the higher interest rate environment over the last couple of years, and I know Ethan touched on this as well, have you noticed changes to covenants or other provisions in debt documents in light of the rate environment that we still seem to be in, even if it's coming down a little bit, still elevated?
Yeah, Kristen. Yes, we have. So I think there are, and it really sort of, the answer sort of is, it depends on which segment of the lending market we're discussing, right? So, I think the answer would be different if we're only talking about the broadly syndicated loan market versus a middle market execution. But I think generally speaking, lenders are increasingly including financial covenants that are that are tighter than what existed going back maybe 4 or 5 years. And this answer is really focused more on the middle market. So liquidity covenants such as an interest coverage ratio that require a borrower to maintain a minimum liquidity level. I think we're seeing that creep its way back into into certain credits that may have been able to clear with just a leverage covenant previously. The benefit to the lender is in an environment where there are greater uncertainties with respect to interest rate or macroeconomic risks. A liquidity covenant such as an interest coverage ratio provides a lender with an early warning system of potential distress in regards to a particular borrower. Specifically with respect to a rising interest rate environment, which this may again shift in the next 6 to 12 months, we'll see. But I would say over the last 12 to 18 months, I've seen an increase in a requirement that the initial closing that a credit agreement include an interest rate hedge, so a swap or similar hedging product that a lender would require a borrower to enter into at the initial closing as a condition of closing and funding of that sort of initial acquisition financing, or if it's a commercial financing, the purpose of which is to protect the lender from rising interest rates. The coverage of those hedges can be up to the full amount of the underlying borrowing, whether it's a term loan or a revolver. And we're seeing this both from non-bank lenders, right, direct lenders, and from bank lenders. If you're dealing with a non-bank lender, then the borrower would engage a third-party bank or other financial institution to provide the hedge. Oftentimes, if you're dealing with a bank lender, the bank itself can provide that product. But that is something we're seeing with more frequency. Going back, prior to the last 5 years, you really didn't. At least I did not see interest rate hedge covenants in loan agreements with any frequency. There were some banks, again, depending on the credit, the size, the transaction, et cetera. Some banks have internal requirements, and sometimes it's a way for a bank to expand its relationship with a particular borrower. But that's something that's become more common. Shifting gears a little bit, wanted to also discuss PIK interest as a way for borrowers and lenders to be a bit more flexible in a rising interest rate environment. So rising interest rates put pressure on liquidity for companies, just generally speaking. And that's resulted in escalating borrowing costs for many businesses, which has prompted borrowers to explore alternative mechanisms within their existing credit agreements and with respect to potential credit providers to alleviate the immediate cash burden of debt repayment. So in walks PIK. So what is a PIK? PIK toggle, or I'm just really this discussion is really focused on a PIK toggle. PIK toggle feature in a credit agreement allows a borrower to choose to toggle and elect to pay interest either in cash or through PIK, a PIK option, where interest is added to the loan's principal balance. And that PIKed interest is generally accruing interest at a premium relative to the cash component of the interest rate. So the PIK toggle provides borrowers with flexibility by reducing immediate cash outflows, but it does increase the loan's principal and interest burden over time. So it's a sort of somewhat of a double-edged sword there, right? Because interest that isn't paid today is going to need to be paid eventually, with interest on interest then sort of compounding. But the upside for borrowers is that a PIK structure reduces the immediate financial burden on borrowers. It's not a new concept. PIK features have been around for many years. Depending on the market and depending on market conditions, they become more popular or less popular. I think, over the last 12 to 18 months, we've seen, maybe a bit more PIK than we had, in prior years, but it's definitely, a technology that's been around for quite some time. And, for borrowers that have financing needs beyond what your sort of traditional senior secured lenders are willing to provide, there are other options. So mezzanine debt, preferred equity, or other options that might be able to fill a funding gap. Again, mezz, pref equity, they've been around for many, many years, right? And used and are still used in different contexts, both in and outside of sort of say sponsor-led acquisition financing, right? They're used in venture, they're used in other contexts as well. But the upside with these products is they can be structured with more creative payment options than traditional senior secured debt. So your PIK toggles with that would be likely more so on the preferred equity. On the mezz side, deferred payments or interest only periods. So in mezz, it's very common for the interest to be deferred for the life of the loan, and then I'm sorry, the principal deferred for the life of the loan, and then borrowers make a balloon payment at maturity, and so the borrower's just paying interest during that period of time. Again, the benefits with these in an inflationary environment with rising interest rates is it reduces sort of the immediate cash burden on a business, right? On a company, on a borrower. And so I think, you know, folks are seeing this with more frequency, you know, over the last 12 to 18 months, for borrowers that may not have been sort of traditional users of preferred equity or mezzanine.
Great. Thank you, Andy. So Ethan, given the market tightening, you know, which types of deals are the hardest to market in this type of environment? And, you know, given that, what options do borrowers have?
Yeah, I mean, it was interesting following the 2024 election. There was kind of a general sense that coming into 2025, they're going to come out of the gate hot. M&A was going to go crazy, be an easier regulatory environment, prospects of inflation cooling, rates coming down. But really, as a general trend, like the first half of the year, it seemed to be limited to more like the strongest names, some of the A companies with great leverage profiles, recurring performance in sectors that were good outlooks, etc. And they were coming to market with very aggressive terms because the other deals were still muted and there were lots of lender dollars that needed to be put to work. So they were able to clear market on pretty aggressive terms. Another factor in that is that some lenders with all this committed capital were willing to take down the entire facility. Versus in a higher volume environment, you'd have, you know, them clubbing up or participating some of this out, where lenders are able to participate in a broader swath and smaller chunks of deals. The sponsors were kind of able to come to terms with one lender and kind of push their grid out and say, take it or leave it. Somebody else may take this whole thing down. So there were A deals coming in with very aggressive terms. On the other hand, the companies that struggled were kind of some of the B and C names that, you know, maybe didn't have as great of a leverage profile, or they were in unstable sectors like manufacturers or retail or energy that are more cyclical or depend on a strong consumer, otherwise, you know, acutely reliant on certain economic conditions or regulatory factors, or companies that were forced to market because they either ran up against sponsor hold times or they were relying on rates going down faster than they did, and now they're at the end of their maturity, or waiting for exit opportunities to improve and they just haven't. So those types of companies being forced to market were harder to market earlier in the year. And of course, as I mentioned, tariffs, there are other names out there, borrowers in jurisdictions or sectors that have exposure to tariffs, which make it difficult for a variety of reasons. Historical performance is less reliable. I mean, imagine an example where a significant portion of revenue comes from, you know, a jurisdiction that's subject to tariffs where they may be selling products there. Buyers will go find cheaper products elsewhere. You know, lenders can't really look at the historical performance and assume that's going to continue in a situation like that. And then you've got models and QVs and things like that have baked in historical performance that need to be, you know, a closer look needs to be taken by the lenders to kind of evaluate that. So that just muddies the waters a little bit and makes it harder to get to a deal. They can also do things where they require special reporting and consolidating financials, splitting out subsidiaries or entities that may have that type of exposure. And it also makes it hard to agree on a purchase price, because if you don't even know what level the tariffs are going to be at the time of execution, people need to figure out a way to address that. And some of the solutions that we've even talked about is like a post-closing structure. If it lands here, the price will be this, and you're going to have post-signing price fluctuations that they'll try to structure as delayed payments or earnouts. And then that, of course, needs to be, or is sought to be, funded by a DDTL, which, you know, just raises additional concerns and difficulties with the underwriting process, the commitment structure, fees. So all of that kind of added up to make it a little more difficult for those B and C names or tariff-related names. So while there was less appetite for that type of credit at the beginning of the year, in recent months, the B and C deals that were not coming to market have started hitting a little bit. And it seems like the pace is increasing. Not to say that there's complete clarity on where the tariff or rate picture is at now, but there's certainly more clarity than there was in April, May, June. And that seems to be giving people enough confidence to transact some of those deals that were more or less on pause for a large portion of the year. There's also an aspect in private credit market that we've seen where as soon as some of the lenders start nibbling at some of the down market deals, other people will kind of follow. there's a little bit of a following aspect there. So I think that's also part of the piece. But it does seem like they're starting to pick up a little bit in those areas. But those are, to this point in the year, some of the names that have been struggling the most.
So Andy, I know we touched on preferred equity, just mentioned it earlier in the discussion, but just talk a little bit more about that. What trends are you noticing in regard to preferred equity, if any?
Yeah. So just to kind of like circle back on what we discussed previously, um, you know, why preferred equity in a rising interest rate environment? Why did we see that more? The answer is really Pref offers a company, a borrower with more creative, flexible payment options than your sort of traditional senior secured debt product, such as PIC, which we talked about previously. So, um, you know, is Pref going to be a one-stop solution for an acquisition financing? Possibly, but what I see commonly, at least in my practice, what I've seen is, Pref is sort of an additional source of capital in the overall capital structure, and is maybe just a part of the overall capital solution. So you may have, an acquisition financing funded primarily with senior secured debt. But there may be a portion of a gap that needs to be filled, and preferred equity or mezz has been used to fill that gap where either new common equity is too expensive or it's unavailable, or additional debt is similarly just not an option or is economically unattractive. So what are some of the features of preferred equity that we would generally expect to see? I would generally expect to see a fixed rate of interest, and I would often see that allowing for step ups to the rate. I would generally expect, again, this is these are features of preferred equity in the context of an acquisition financing. I'm not addressing VC pref or pref used for upstream at like a sponsor level to for other purposes. I would generally expect to see pref include a call protection, and I would generally expect to see preferred equity include affirmative and negative covenant. So then you say, oh, well, that sounds a lot like that. Well, yes, and no. Now, you got to be careful there, and it's important that you work with your attorneys because you want to structure the preferred equity to avoid it being classified as disqualified equity for tax purposes, which would be a bad result. So some sort of typical features that are used to avoid this, and what does that mean? That means your preferred equity looks so much like debt that the IRS, for U.S. tax purposes, considers the pref disqualified equity, which could have an adverse tax result for the investors and for the borrower. So features to avoid disqualification include, like I mentioned previously, allowing for step ups of the rate, which is, and these are all sort of like, if you think about it, oh yeah, you don't see that as much, or much with senior secured, although you do have, that's not universally true. You would be very cautious and maybe like want to steer clear of having redemption rights running in favor of the holder, and that you would include PIC features. And PIC is often very frequently associated with preferred equity. Another item which distinguishes preferred equity from a traditional debt obligation with sort of scheduled cash payments. So again, as we discussed like 10 minutes ago, there may be senior secured solutions that include PIK features. In fact, that's something that has made its way into the market. But so those are some of the trends that I've seen with preferred equity over the last year or so, and some of these have evolved like over time. Like these are not new inventions again, um, but I guess those are some of the things to think about.
So Ethan, what are you seeing with respect to equity cures?
Yeah, so for a lot of the reasons mentioned previously, where the market and the rates are at, borrowers at certain leverage profiles or in certain sectors may be facing a little bit more of a grim outlook in terms of performance and available capital, at least in the short term, and are running into workout scenarios where sponsors need to infuse dollars into the business or otherwise support the portco. But even in these scenarios, we don't really too often see sponsors or borrowers utilize equity curates like within the four corners of the doc or under the pre-baked formulations. Um, those pre-baked formulations are usually pretty limited in the benefits that are provided to the sponsor where they do put in equity. For example, they usually require just common equity, so there's no preferential characteristic there. It's just common equity. Only counts towards EBITDA for the specified period. It's often capped at the amount to cure the breach. And a lot of these agreements require or trip a mandatory prepay where they have to actually put the proceeds to pay down a loan, which if liquidity is an issue, that just doesn't help your liquidity position. It just reduces leverage. There's also frequency limits, often 2 per 4 quarters capped, sometimes no consecutive quarters that can be cured. And it's 5 per the life is the common formulation. So in light of that, it's a pretty rare case where there's a true 1 quarter trough in EBITDA where as long as they put the dollars in, everything will be fine in the next quarter. So they're likely to request, resets or concessions on those frequency limits. So all that is to say, while the sponsors have a pretty easy path to injecting equity, they can just call capital. The lack of, improved prospects for future quarters and the limited benefits means we often see them more likely to try to negotiate an amendment that gives them covenant relief, some kind of structured runway where they can have some time to improve performance and not have to request cure after cure. That's especially true in private credit, where it's more of a relationship-based situation, where they're more likely to participate in negotiating a package that can include, covenant, or if it's liquidity relief, they sometimes will offer PIK rates, like Andy mentioned, to provide some interim liquidity in a trade for what we usually see are like baskets being tightened, additional financial covenants like a liquidity covenant Andy mentioned. They could tighten EBITDA add backs, reduce cash netting flexibility by requiring DACAs, kind of tighten the screws on some of the control requirements. They may include additional reporting like monthlies, liquidity reporting, or cash flow forecasts, just kind of taking a closer look and being closer to the situation where they've agreed that with this equity cure, we're going to give you more concessions, but we want to have more insight into what's going on. Oftentimes, they also may require additional credit support from the sponsor in the form of like a sponsor guarantee, or we see equity commitment letters. The difference there really being that sponsor guarantees, we've seen them triggered on a liquidity breach. If liquidity falls below a certain level, then the sponsor has to put in their equity. But the main difference from a lender perspective there is that sponsor guarantees run in favor of the credit that the lenders can enforce directly, whereas an equity commitment is more of a commitment from the sponsor to the borrower. So it's harder to enforce in a downside scenario. So we see the preference for guarantees, but sometimes that's just not possible on the fund side where they may have restrictions on how they book it. So they may want an equity commitment. And lenders kind of negotiate those equity commitments to look as much like a guarantee as they can for bankruptcy purposes, while allowing the sponsor to provide it in the form of an equity commitment, which is easier or maybe easier for their fund level stuff. There may also be, like I mentioned, that since there's frequency limits, if you're coming to the table negotiating a full package, it's also common for them to either reset that or sometimes the other side of the spectrum, they say, okay, here's your runway, here's the one deal we're going to do, but no more cures in the future. So it's not an option to take advantage of the covenant package that you're getting now and then just do another cure when you need it again to kind of bleed out the business further. So that's kind of what we've been seeing. We don't really see people exercise it just on the four corners because oftentimes it's not just a 1 quarter issue and they need a little bit more runway or maybe some other concessions and flexibility in the document. So we see them negotiate for that, but then the lenders also making sure that, things like LME provisions, they'll take a look at that and make sure that if you get backed into another corner or liquidity corner, that you're not going to go somewhere else and do something lender on lender in that situation. So those are just all the things we see negotiated in these deals where they are not really using the equity cure within the pre-baked framework.
Interesting. Thanks, Ethan. Sounds like maybe that pre-baked version is now more likely only in an emergency situation if they weren't thinking about it in time or caught off guard.
Yeah, that's right. We have seen it exercised at least once though, where it was a true 1 quarter trough, but certainly not the norm.
Yep. All right. So Andy, in middle market transactions, what are you seeing in terms of trends with financial covenants?
Well, so I think that the creep down from the broadly syndicated loan market has continued, despite, headwinds, economic headwinds, interest rate, an adverse interest rate environment, inflationary pressures, macroeconomic and geopolitical pressures. That creep has just continued unabated every year that I practiced, which now I'm in my 20th year. So I think the short answer is that your sort of push to down from really the bond market to the BSL market, to the middle market in terms of more aggressive, more borrower friendly terms continues. So let's focus on I guess a couple of things to kind of focus the conversation. Has Cov Light continued to make its way into the middle market? I think the short answer is yes. So what does that mean? So just for this, set the stage a little bit. In the United States, according to Reuters, in the U.S. institutional leveraged loan market for 2025, Cov Light loans accounted for approximately 93% of total issuance volume as of July of this year, which is similar to the 93% in 2024 and 2023. Now, that's in the broadly syndicated loan market. In Cov Light loans, what does that mean? All right, so in a Cov Light loan, there are no periodic maintenance tests to provide lenders with an early warning system for borrower's performance is deteriorating. Instead, there's a single financial covenant. It's based on leverage, senior leverage, total leverage, but it only benefits the revolving lenders in connection with that facility. There are no financial maintenance covenants for the term lenders. It's almost always a springing covenant, meaning it's tested only if the revolver is drawn at the end of a fiscal quarter and an amount that exceeds a specified percentage, usually set at around 35 to 40% of the aggregate revolving commitments. And the covenant levels are initially set at a constant, like with no step downs, and a significant cushion to the sponsor model. That cushion is usually like 30 to 40%. Again, this can all be negotiated. There may be variances. There may be variance. You may have seen different things in your experience. This is just generally speaking, that's Cov Light. In the middle market, Cov Light, I didn't see Cov Light make its way and clear a true middle market deal. And what do I mean by middle market? So by middle market, I mean like 25 to 50 million in EBITDA. Above 50 million in EBITDA, I think that's more upper middle market. And it's, I think you do see more aggressive terms there in terms of where do you see, Cov Light the most. It's for sure the 50 million plus mark. I even today, I think a credit would really struggle to clear at sub 50 million with a Cov Light execution. personally haven't seen it with much. I'm struggling to think of any examples, but you do see it in the upper middle market. So 50 million plus in EBITDA. And you see it more and more, right? It's here. It's not going anywhere. It's not going to go away. Direct lenders, to be competitive, are not going to, I think, be successful in effectively pushing back on covenant light for quality credits, and quality larger, sort of upper middle market credits with sort of brand name sponsors. Kind of in tandem with that, in terms of like, how do we calculate some of this stuff? Cash netting, which is used in connection with calculating leverage, and the leverage test or leverage covenant under a credit agreement, including under a Cov Light deal. It's become increasingly common for cash to be deducted from the amount of the revolving facility commitments that are drawn at the relevant testing date. And the absence of cash on cap netting has become more and more common. What do we see in a distress scenario? I think when a borrower is in distress, right, where it's missed covenants, it's missed interest payments, the leverage, the negotiating leverage, definitely shifts in favor of the lenders, and we'll often see a lender tighten covenants to protect its investment, and to provide it with additional early warning systems to look for any further decline. Lenders will frequently impose minimum EBITDA covenants, minimum cash balance covenants, and include additional covenants regarding budget variances and related delivery. So what's a minimum EBITDA covenant? It's in a distress scenario, it's frequently set at a level that's just below the company's current performance. So there's a small cushion, but it's tested monthly, quarterly, and the EBITDA add backs, I would say, in connection with calculating a minimum EBITDA test, are going to be much tighter than the add backs that you would see sort of in a front end execution, where sponsors and borrowers have greater flexibility and can be more creative with add backs, and lenders are more accommodating in that scenario. Liquidity tests, or your minimum cash balance, typically tested weekly, require borrowers to submit a 13-week cash flow forecast. The breach of a weekly minimum cash balance covenant is a default under the forbearance agreement or whatever, if you're working under an amendment to a credit agreement. And a budget variances just requires a borrower to meet certain targets relative to a pre-approved budget that's provided and approved by the lenders. It allows lenders to closely monitor a borrower's performance and to ensure that management is adhering to the agreed upon turnaround plan. But yeah, I think, just big picture, I think that the technologies, the the overall sort of loosening of covenants that have occurred in the bond and BSL markets over over time, have made their way into the middle market, and despite challenges and economic challenges or interest rate environmental challenges and pressures, I don't see those technologies going away. There's just too much competition with banks and non-bank lenders chasing and competing for AUM, and yeah, I think that those changes are here to stay.
Thanks, Andy. So Ethan, Andy just mentioned the ability in some situations to get, I think he said, creative with EBITDA add backs. On that topic, what any trends you notice in EBITDA calculations I guess particularly to stay in the same space that Andrew was just talking about in the middle market financing space?
Yeah, definitely. There's still definitely continued emphasis on some of the more primary add backs like the extraordinary non-recurring items, restructuring, business optimization, reorganization charges, and the run rate pro forma cost savings add backs. Within these that have been around and kind of across the board for any other add backs that may be subject to caps, which are more prevalent, I guess, lower middle market, but still in the middle market as well. There's a push for higher caps kind of across the board, where we're seeing up to, from 25 to 30 to 35% for what used to be an aggregate cap, but now there are fewer capped items. So it's really just fallen away to just the run rate and cost savings items. And we've seen within that longer look forward periods that are pretty commonly 24 months now, where it used to be 24 was on the longer end of the spectrum, and we would often see 12 or 18 months. Those are looking more like 24 months pretty frequently now. And things like backup certifications and calculations that were not always present in middle market, upper middle market, but definitely in some lower middle market deals are kind of falling away. And as I mentioned, there's a continued effort to split out anything from those add backs like restructuring, et cetera, to separate standalone baskets that may not have caps at all, where they used to be an aggregate cap or looped in with some of the other stuff. Even some of those run rate cost savings add backs, we've seen some more upmarket deals where they carve out certain transactions from that, where they'll carve out, cost savings or pro forma run rate in connection with acquisitions and investments, which obviously would be a big piece that would fall, you would expect to be subject to that cap. So there's certainly a push on that front. There are also some more specific add backs that we've seen push for, and lenders are getting more and more comfortable with. For example, of the type add backs reflected in a QVR model, which allows a borrower to bring forward add backs in future transactions that otherwise would have been specific to the closing date transaction. We're seeing more new contract and deferred revenue adjustments that kind of allow them to bring forward, hey, we signed a new contract, we expect it to yield this much revenue, we're going to act as if we realize that today. And also greenfield, de novo openings, stuff like that, that typically are capped in the middle market, but those caps are either growing or going away entirely. And a lot of these add backs may make sense for certain businesses, but not all of them. And we've seen them kind of asked for or applied in a more buckshot approach than a nuanced, like need-based manner. And sponsors or lenders are getting more comfortable letting those through. Another one is the Reg SX add backs that historically they didn't have a management adjustment concept in 2021, I think. Those were added, and now folks are focusing on adding language that prevent those management add backs, or locking it in either pre-2021 or saying, fine, you can have Reg SX, but other than management add backs. So those are kind of some of the other ones that we see being negotiated and asked for, even where they're not necessarily specifically tied to the business in question. Another one is a tariff-related add backs, where these sometimes are just kind of in EBITDA add backs as part of a historical form, a catch-all, like not really intended, or we're not considering a situation like we're in now, where now that those are just in there, people are kind of looking at them and scrutinizing them a little bit more closely to see if it makes sense for this business given the current environment. So I guess that's another one that I think has popped up more recently.
Great, thanks, Ethan. So Andy, I know we've mentioned many times in this discussion so far the words private credit are referred to private creditors, and that does continue to be a hot topic and is here to stay. Can you talk a little bit about private credit and what it is and what its role in the market is?
Sure. So what is private credit? My answer is going to focus really on direct lending, as opposed to the broader private credit. So I'm not going to address venture capital or distressed credit or other types of private credit. But direct lending is non-bank lending, typically to middle market companies that are frequently owned by private equity sponsors. Direct lending has grown exponentially since really the mid 2000s, but I would say starting in 2008, coming out of the Great Recession. Moody's in a recent article predicted that the global private credit AUM is going to jump to $3 trillion by 2028. Where do the direct lenders participate? Again, at least in my experience, in my practice, the answer is it depends a bit. But most of the direct lenders that I've worked with have focused almost exclusively on acquisition financings in connection with sponsor-led transactions. Some direct lender, pardon me, well, I would say some direct lenders focus on different segments of the market. So there are some direct lenders that focus on the lower middle market. What do I mean by that? And this is not disparaging in any way, but I just need to define things. I define lower middle market as anything below 25 million in EBITDA of the underlying borrower. Middle market, again, 25 to 50 in EBITDA, and upper middle market is 50 million plus in EBITDA. So there are direct lenders who, like I said, focus on sponsors and kind of play in different segments of the market, whether it's lower market, lower middle market, et cetera. Some direct lenders will originate transactions, and so they'll act as the administrative agent. They have the back office, and they've built out their sort of their direct lending team to the point where they can actually provide those services. Other direct lenders are really just buying paper, and that you'll see that more commonly, I think, with I would say smaller direct lenders, or maybe direct lenders who are just sort of getting started. They're still growing their AUM, so they may just be buying paper in sponsor arranged clubs or similar deals. What we've seen, really, I think going back to maybe like since around 2015, 16, 17, increasingly over the past 5 years, though, we're seeing direct lenders stepping in and underwriting large leverage financing. So, for example, last September, Gallo Capital closed an increased unitranche of 4.45 billion, which I think at that time was the largest. I'm sure there's an even larger one, subsequent to that, but direct lenders can and do, especially the larger direct lenders can and do have the capability to take down very large facilities that historically would have been a BSL execution. And that's I think a byproduct of the fact that there has been, again, so much growth in that space over the last 15 years. And you have very large, very capable, very sophisticated direct lenders who are competing directly, as Ethan mentioned earlier, are competing directly with your traditional kind of BSL big bank players. One of the questions that I think sometimes it may be like a conversation point or a selling point with respect to direct lenders is, in the context of a sponsor arranged club, where you've got, a small group of lenders who are joining together to provide the financing in connection, usually with a bigger deal, but it doesn't have to be, right? It could be a three-handed, smaller deal where just the sponsor wants to have a small club instead of just dealing with a single lender. it offers a more streamlined and flexible approach, certainly relative to a BSL execution. From a borrower's perspective, the process leading up to the initial closing may be more efficient and maybe faster, where it's not dealing with, it's just dealing with, a handful of lenders. And I think importantly from a borrower's perspective in a distress scenario, your borrower may benefit from simplified negotiations, which just dealing with, the smaller group of lenders, which presumably it's developed, relationships with over the course of, the life or the term of the loan, and can leverage those relationships in connection with, if there's a, workout restructuring or related negotiations. If a borrower is experiencing distress, that might be another benefit for you borrower folks out there.
All right, switching gears a little bit, Ethan, are you able to briefly discuss priority revolving facilities and any controversial or interesting features of those?
Sure, yeah. In my experience, they weren't too prevalent. Certainly, the syndicated market where you'd more likely see kind of a term loan on one hand and then an ABL revolver alongside that provided by a bank or whoever it is, or in the upper middle market or middle market direct lending deals where, as Andy mentioned, some of them have built out more of a back office and capability around revolvers. So it's a little bit more common further down market where they might not have as robust a balance sheet or capabilities, operational capabilities around revolvers. However, recently we have seen it popping up in a handful of middle market and upper middle market deals. We've talked about the rate environment, and rates remain high, although they have started to go down. But in that type of environment, borrowers are looking to lower their cost of capital. And one of those ways is to get a bank to provide a revolver, which is often cheaper than getting it from your middle market term lenders. So it's really been the sponsors driving bringing these structures in. And then on the flip side, we've actually seen some of the private credit lenders try to get ahead of this by providing their own priority revolver within the structure at a lower price, to prevent kind of the sponsor going out and getting a bank to step in front of them. So that's really, I think, the most notable development is that they've seen this structure coming in from the sponsor side who wants to just get a cheaper revolver, and private credit lenders who have the capability saying we can do that too, and finding a way to provide that, even where they may be in the term as well, which it gets to be a little bit of a hairy negotiation, but it's an interesting thing that we've seen popping up. Within these structures, they can kind of come in different flavors where they can either have simply waterfall protection or special voting enforcement rights in certain situations embedded in the credit agreement, or there's a full AAL agreement among lenders. Sponsors, borrowers definitely prefer them to be in the credit agreement so they know what the agreements are versus an AAL that's separate and not visible to them. But the points of contention here are generally what the triggers are that trigger the waterfall, or a payment diversion where in some scenarios upon a triggering event, any voluntary and or mandatory prepays will be applied to the revolver, for example. Some of them are only mandatory, some they'll also try to pick up voluntary. But these types of trigger events almost always pick up payment bankruptcy defaults, financial covenant defaults. Those are sometimes negotiated with a cushion. They have to be violated by 10 or 20% or more, for example, for those to trigger the waterfall, or like a change of control. Some of the more fringe triggers would be financial statement deliveries, monetary judgment default, certain negative covenants. And I touched on earlier, but sometimes there are voting rights that are being negotiated customarily. They will always include priority consent rights over priority affecting provisions like the waterfalls or the priority treatment of the revolver in an enforcement scenario. They could also push for a required lender. I've seen where they have special required lender rights, where the required lender definition flips to a majority of the priority lenders during certain events that may or may not align with the triggering events. Another point of contention are bankruptcy provisions, where the priority usually wants, or they sometimes will want a statement of priority or subordination expressly in the document. So that is, I guess, a better argument for them in a bankruptcy scenario, that there is subordination there. And they've also asked for provisions where term lenders agree that they won't approve a dip that either rolls up term debt or brings in other priming debt. So those are kind of the bigger voting and bankruptcy provision rights that we've seen negotiated. And then another one is just whether there's the right for the term to buy out the revolver in a downside scenario, and what the contours of that right looks like.
Got it. Thank you, Ethan. So Andy, in terms of specific changes or trends in documentation specifically, any recent notable changes to leverage finance documents that you think we should briefly chat about?
Yeah, definitely. So 2 regulatory and 1 ESG. So on the regulatory front, outbound investment rule provisions under a credit agreement have made their way in. This is so basically, so any lender that's making a loan to a quote covered foreign person engaged in covered activities, for example, that person is working with semiconductors or quantum tech or AI, that lender should consult with counsel to ensure compliance with applicable U.S. law. There are additional diligence, notification, and record keeping rules that may apply to those transactions. And if you're looking at just some boilerplate outbound investment rule provision, recommend you run it by counsel and make sure that it's up to snuff. The second regulatory driven item is in confidentiality agreements and the confidentiality provisions that are typically included at the back of your credit agreement. You should take a look and consider updating your form to permit disclosures by whistleblowers to regulators such as the SEC. The whistleblowing regulations have been a focus of the SEC, and that's something that we recommend you take a look at. On the ESG front, sustainability linked loans, so sustainability adjustments, which link a loan's pricing, basically interest rate and fees, to a borrower's achievement of predefined KPIs or key performance indicators for sustainability. If a borrower meets the sustainability targets, a borrower may receive a price reduction. Failure to meet targets can lead to an increase in pricing. Note, these are not green loans. That the proceeds of these loans can be used for general corporate purpose. The primary focus on sustainability linked loans is on overall environmental, social, and governance improvement. And as that market continues to evolve, we may see an uptick in sustainability adjustments and sustainability linked loans. I think more to follow there. It's an evolving space, but something to keep in mind.
Thanks, Andy. I know we're running out of time, and this probably is not the best question when we only have about 2 minutes left, but Ethan, for the best you can do in 2 minutes, any trends you're noticing regarding liability management transactions?
Yeah, sure. We'll keep it brief here. I mean, the general trend is kind of continuing where these are being pared back more over time. I guess time heals all wounds, and the further we get away from the transactions that trigger them, the more people are convincing lenders that they don't need to be concerned about it, especially in private credit where LME is not as prevalent because of the relationship dynamics. Few examples of that. I will caveat, I have not seen this clear market, but we have started seeing it pop up in grids and marketing term sheets where deals are not having any envisioned protection or restrictions on leakage to unrestricted subs. Again, have not seen that clear market. Seeing J. Crew going back generally to only covering IP. After Pluralsight, people got very concerned that they were going to use use the same trapdoors to transfer non-IP material assets. So that's kind of going back to material IP. In the vein of Pluralsight, the initial reaction was no material assets or other IPs to non-loan party restricted subsidiaries. Some deals went as far as to tighten all the baskets with leakage to non-loan party restricted subs. We've kind of seen that landing more, and you can't transfer material IP to non-loan party restricted subs for the purpose of raising or supporting structurally senior debt. One more I'll mention quickly is DDTL vote rigging concerns, where people were concerned that you could raise incremental DDTL commitments under the unlimited ratio prong without assuming them drawn or testing them at incurrence, use those commitments to have full voting rights to sway rec lender votes. There are a few formulations from blocking them completely, only permitting them up to what could be drawn at the time of the vote. And where we've kind of seen it landing is the third option is allowing those commitments to vote to the extent they were raised for a bona fide business purpose. So those are a few of the high-level quick bullets of what we've seen trending lately in LMEs.
Great, thanks, Ethan. Well, that concludes today's discussion. Thank you to Ethan and Andy for sharing their expertise with us today, and thank you everyone for joining.